Hi there, welcome to Nepi Invest. Time to talk about a company I have not featured in any of my videos before, and that company is Brookside Energy, a small cap producing or oil and gas producing company on the ASX. And in terms of valuation, this company is looking really interesting because in the last 12 months, this company produced $30 million of operating cash flow. Now, this is not free cash flow, it's operating cash flow. But still, that's a lot of money to be producing in your operations. Yet this company has an enterprise value of only $27 million. So the enterprise value is lower than the operating cash flow this company produced in the past 12 months. So why is that? Why is the market not interested in this company? And I have a few possible reasons behind that. And even though I have been following this company for about 2 or 3 years, I have never been interested in taking a position in this company for one simple reason. And I'll discuss that reason in the next slide. So Brookside is an oil and gas producer within the Anadarko Basin of Oklahoma. In fact, the Anadarko Basin is just south of where I used to live. I used to live in Oklahoma. In fact, I lived there for about 4 years in Norman, Oklahoma. And in fact, Anadarko Basin will be not far away from there. So sort of an area I know, I wouldn't say well, but I do know this area fairly well, better than most ASX investors anyway. This company listed on the ASX back in 2005 as Red Fork Energy. I know nothing about Red Fork, and I don't know how Red Fork Energy transitioned to Brookside. There's could be many reasons behind that, and I'm not that interested in the history behind Brookside, unless you're talking about the shares on issue. Before we talk about the shares on issue, the current managing director is David Prentice, and he has a 2.2% stake in Brookside, but the shares on issue is probably too high, in my opinion. 5 billion shares on issue. And the reason that can be a problem, particularly when the share price is really low at 1.2 cents, and that's the share price right now with Brookside. Because when the share price gets down to that level, with that amount of shares on issue, you get a lot of PIP traders out there. So what PIP traders do is they try to buy shares in a company at 1.1 cents and then sell straight away if the share price gets up to 1.2. And it's just rinse and repeat. So I don't like buying positions in companies that have a lot of shares on issue, and 5 billion shares on issue is way too much. And added to that, they have a share price about 1.2 cents. So I refuse to buy companies with a share price less than 1 cent if they have more than 1 billion shares on issue. So that is the major problem when it comes to Brookside. And there is one way they can solve this issue, and that is doing a share consolidation. And probably say at least a 10-to-1 share consolidation. So get the shares on issue down to 500 million. So that means share price would increase to 12 cents. Better yet, maybe a 50-to-1 share consolidation, get the shares on issue down to $100 million. That means the share price would be at 60 cents. So that's fairly easy. Times 100 million by 60 cents, you get a market cap of $60 million. And if you do that, you totally instantly get rid of those PIP traders, and they find another stock on the ASX that has heaps of shares on issue that is trading around 1 cent. And probably the other thing I've also heard is a lot of people say, well, you don't really need to do a share consolidation. 5 billion shares is not an issue here. But myself, I refuse to buy into Brookside simply because of this reason. So you do open up that possibility, that potential of bringing new shareholders into or onto the registry if you do a share consolidation. Now, if they do a share consolidation, I won't necessarily buy shares in this company. But because they do have 5 billion shares on issue with share price at 1.2 cents, immediately I won't take a position in this company. And the ticker code for Brookside is BRK. I have been following Brookside for a few years because they are a producing company. They are producing a product. They are selling. This is very important. This is a real business. So in the next two slides, we're going to look at the December quarter results. They're Appendix 5B, looking at the statement of cash flow. And we get to see how this company has grown over the past year in terms of receipts from customers. Not only receipts from customers, but also the operating cash flow has grown over the past year. Yet even though it has grown over the past year, the share price has done the complete opposite. It's fallen backwards. So 1 year ago, this company had receipts to customers of $3.6 million in the December quarter and was operating cash flow positive by $2.8 million. Now, this company does spend a lot of money on exploration and evaluation and capital expenditure. So even though they were operating cash flow positive, more than likely they would have been either free cash flow negative or very close to being free cash flow neutral because of that spending in investing and the other activities. But at this point in time, they did have $12.8 million of cash on hand. And this is very important to build your cash on hand. And the reason it's very important, I'll talk about that in a few slides when it comes to capital allocation. And capital allocation, in my opinion, is one of the most important jobs when it comes to the CEO. And very rarely you do see really good capital allocation from CEOs. But if you do find a CEO who's really good at capital allocation, that is a major step to calling that particular CEO a great leader of a company. Now on to the most recent December quarter, and this is not for financial year 23, this is just mistyping, misprint from me, because this was the last quarter of their financial year. So their financial year is the same as the calendar year, and the December quarter, the last quarter, was the last quarter of the financial year 2022. So this was December quarter for financial year 22. Anyway, that's not really important. The most important thing about their December quarter was this company is growing in terms of receipts. So receipts up to $16.3 million for the quarter and $52.9 million for the financial year. And the second most important thing is they are able to translate that increase in receipts to increasing their operating cash flow and the free cash flow. So the operating cash flow increased to $8.6 million in the most recent quarter. And for the financial year, this company produced $30.5 million in their operations. Now, that's not free cash flow because this company does spend a lot of money on capital expenditure and exploration and evaluation. In fact, in this quarter, they spent $1.9 million on capital expenditure and $5.3 million on exploration and evaluation. So the free cash flow was significantly lower than $8.6 million. In fact, it was just above $1 million. The other thing, this company did have some favorable exchange rates, and that added $2.7 million to their cash on hand. So let's talk about their cash on hand. So at the end of the financial year, this company had $32.9 million of cash, and I don't think they had any debt, which means the enterprise value, and if you don't know how to calculate enterprise value, it's fairly simple. You just take the markup and subtract the net cash. If they had net debt, you have to add it to the markup. But because this company has net cash, you subtract that from the market cap, which means $60 million minus $32.9 million gives enterprise value of this company of $27 million. And the way to look at enterprise value, that's the true valuation of a company because you're taking into account the cash and the debt. So the most important thing this company's management have to decide to do is what to do with this $32.9 million of cash. So let's talk about that right now. Now, I've already mentioned this, I think in this video, and I've mentioned this in many videos in the past, that in my opinion, the most important job of the management of a company, the CEO of a company, is dealing with capital allocation. The most important decisions is what to do with the cash flow that is generated by the company. And those sort of decisions can either make or break the future of a company. We have seen absolutely awful decisions by management teams in the past on how they've dealt with the capital or the financial resources a company has. A great example of that is Slater and Gordon. The capital allocation decisions they made in terms of acquiring that Quindell in England destroyed that company. So in my opinion, capital allocation is the most important job of the CEO of a company now, or the managing director of a company. Now, you could argue with me, creating culture is very important as well. But I don't think creating culture is quite as important as capital allocation decisions. So what is capital allocation for those who don't know? It's all about how to distribute and invest a company's financial resources to increase a company's efficiency and to maximize its profits. Another way to look at it is to allocate its capitals in ways that will generate as much wealth as possible for its shareholders. For example, capital allocation decisions a company can make include dividends, share buybacks, acquisitions, or research and development. So those are some of the things or ways a company's management can deal with the cash that is generated by the company's operations. And that's the sort of decisions that Brookside management have to make in regards to how to deal with that $33 million of cash. So more than likely, they're not interested in dividends. Now, even though I do think this company might be cheap, share buyback might not be part of their plan. So more than likely, they're going to go down that path of acquisition and spending money on exploration and evaluation. And that's how they're going to deal with trying to create value for their shareholders in the long term. But if you look at the chart right now, the market is not interested in this company, even though you could argue that based on the financials and the valuation of this company could be undervalued by a significant amount. So this particular chart is the daily chart going back to October 2020. And the reason I've gone that far back is because I wanted to include the period between about November, December 2020 to about August 2021, because the share price of this company went on a bit of a run. There was interest in Brookside in that small period, about a 9-month period. In fact, the share price went from about 0.4, 0.5 cents in late 2020 to a high of about 4 cents in August 2021. So a nice 8-bagger in a fairly short period of time. Not only that, the share price was in a beautiful uptrend, maybe not beautiful, but traders were taking notice to this increase in interest in this company. And that increase in interest can be, you can see it fairly clearly in the volume, really high volume, particularly between February and about May of 2021. So traders will see that. They will see that increase in volume, that increase in interest in this company. They'll also see that the share price is going up in a beautiful uptrend. So they might take a short to medium term position in this chart to ride the uptrend as long as possible. But then that uptrend started to turn sour in September, October 2021. And since then, the share price has been going down. Not only has the share price been going down, we have seen decreasing volume as well, which is telling us the market has become less and less interested in this company, even though you could argue because of their financial state, this company is becoming cheaper and cheaper. So we need to see a return in volume. We need to see the market more interested in this company. And I think the first way to get more interest in this company is to a share consolidation, because I personally would become more interested in taking a position in this company. I won't necessarily take a position, but I would become more interested. And the other reason I'm not interested in taking a position in this company right now is just the share price is in a downtrend. And if you take a closer look at what the share price has been doing over the past, say, about 6 months, we can definitely see pip trading happen. The share price going up by 0.1, down by 0.1, up by 0.1, down by 0.1. So it's just these pip traders trading that 0.1 cent pip rise, and they get a 10% return if they can time it right. And eventually that has to come to an end. And the best way that can come to an end, in my opinion, is do a share consolidation. That's all I have for this video, looking at Brookside, a company that produced $30 million in operations in financial year 22, yet only has an enterprise value of $27 million. So you could argue this company is looking really cheap right now, but for some reason, the market is not interested in this company. Could it be because the company has 5 billion shares on issue? Or maybe there's some other reason that I've completely missed. So if you do know this company a little bit more than I do, and you do think there's another reason why the market is not interested in this company, I'd love to hear about it. And so leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.